FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and it is April 24th, 2020. Well, watching the shutdown is continuing. However, 8 states in the U.S. are no longer shut down. I was thinking of getting a new tattoo, and I'm in Florida. Georgia is the tattoo parlors are open. I can get a haircut, I can get a manicure, and a massage. So what kind of tattoo should I get? Do you have an opinion? We'd love to hear from you. The email address is kl@kerrylutz.com, kl@kerrylutz.com. Really pleasure to have our good friend Bob Hoye on with us, because I've been wondering about historical instances of pandemics and the effect that they've had upon the economy and how they're hurting you now. What's happened before? Because quarantining kind of goes back to the Middle Ages and the Black Plague, and it's probably been as effective this time as it was then. But Bob, ace economic historian, what is the pandemic? How does it reflect in history when we've had these periods before?
Yeah, good question. And I had, of course, did the history of the financial markets dating way back. And so I thought, now, when have you had a distressed financial market with a health threat, like a contagious disease? Well, then I remembered that in London in 1665, there was the Black Death visited, and I think the die-off was about 20%. But those were really choppy times, and it was also boom times. And in London then, in the 1660s, there were enough joint venture or publicly traded stocks to kind of call it a stock market. So in 1664, there was an on-off threat with war with Holland. And Holland, of course, at that time was the commercial and financial center of the world. So that was important. So then you had those events and worries roiling the financial markets. Then, as I said, in 1665, you had the Black Death, the plague, the dreadful one, and some 20% of the population died on that one. And then you figure, okay, that we're all fine now in the next year. And I think it was in October of 1666, they had the Great Fire in London. And 70,000 out of 80,000 accommodations were lost. So can you imagine what that one did to the financial markets? So, and then you've got examples in about 1550s when Sir Richard Gresham was the financial agent for the British Crown in Antwerp, which was the money market. And he writes that in this panic, which was a financial panic, that money could not be obtained at even with double collateral. And oh, by the way, there's a touch of plague going around. Mm-hmm. So I think that, Kerry, that the health threats, various infectious diseases, don't do the markets. The markets do themselves. And in this case, on our work in October, you recall we were looking for a pretty good rally out till the turn of the year, like say around January. And we also noted that they used the examples of previous good speculations that had completed in January, and of course gold and silver in January 1980. Then you had the Nikkei phenomenon in last trading day of 1989, and then January 1973 was also an important cyclical peak in the stock market. So there have been a number of really good bull markets in a number of items complete at the turn of the year, and then go into a bear market. So this is what we were using, and indeed in early January wrote that that everything was geared for a decline, and being a bubble, that the financial bubble, that the economy would turn down effectively with the stock market, and then noted that we have no idea what the story will be for the turn down, and the media would come up with the story, and of course it was the Wuhan virus, the flu, and that really did, Kerry, put a very fast shutdown to activity really around the world. And unfortunately, much of it has been very ambitious governments run by control freaks extending their control. Mm-hmm. And we're seeing now in various jurisdictions, like I was just reading about North Dakota, they didn't put on any serious hard stuff, and their experience has not been horrendous. And I do admit that this is, for certain age groups such as myself, is a very threatening flu. But overall, I think perspective will come back in, and it will be seen as another example of ambitious leftists going for control, and in so doing immense harm to the economy. But then, Kerry, what we're doing is we're just staying with our theme about how previous great financial bubbles have concluded. And I guess the most compelling one was that last summer, the yield curve, which is the difference between long-dated and short-dated interest rates, it inverted, with short rates getting higher than long rates. Mm. And that's a sign of speculation, because it shows there's a terrific demand for short-term money, much of it for speculators getting leveraged up. So then by October, the curve was no longer inverted, and those who were new to studying the curve said, oh, the threat's off, but they don't understand it. And I've got the yield curve back to, I think it's 1857, and the rule is that the curve inverts, you get a recession every time. Mm-hmm. So then we went into December, and with the speculation in stocks and low-grade bonds again, the curve inverted again. So you had the double inversion. So I checked back, and when have you had the curve invert twice? In 2007, and you know what followed there?
Sure.
1929. Mm-hmm. And then the great bubble of 1873, which not that many people are familiar with, but it was a classic bubble.
That was the old Great Depression.
And it inverted twice there, and then you went into as a matter of fact, in England, which was the senior economy, the prevailing weakness was such that by 1884, economists began describing it as the Great Depression.
And it lasted 20 years.
From 1873 to 1895.
Right.
And even leading economists as late as 1939 were still analyzing the Great Depression and how it could have been made less or ameliorated or prevented. As I said, until 1939, when they looked around and said, oh, we've got another Great Depression. So, Kerry, the history of financial markets and the history of intellectuals, it provides wonderful irony. And it's still happening here, because the street really believed that a Fed cut, nicely timed, would keep the boom going. And on this one, we get pretty adamant, and again with financial history over the last 300 years, that short-dated instruments like T-bill rates, they go up in a boom, and they go down in the bust. So the central bank fans have got cause and effect all screwed up. And the other thing is that when you're in a year where you might have the conclusion of a great speculation, then the interest rate, the T-bill rate, turns down before the bubble's over. Like in 1929, the T-bill rate went up until May, and in June reversed to going down, which was the pre-warning on the end of speculation. And then same thing here, the T-bill rate went to peak last March. And then the Fed then lowered rates last summer. I think the lag was about 5 months. So the other thing about this, as I said, Kerry, is irony. And when you're in a crash such as we have had, the T-bill rate goes down the fastest in the worst part of a bear market, like the early stages. And here we had it again. But you had people during the fall saying that the Fed would cut rates and that would keep the bubble going. And the bubble crashed and interest rates come down. And that's the way it works. And I can't believe that they still push this story that when a big bull market is getting a little nervous, then they all come out, Wall Street pundits come out and say, oh, well, the Fed's going to cut and we'll be fine. And it has never worked in history. So then, again, Kerry, as you pointed out, it's been made a whole lot worse by this Wuhan flu. And so what you have now is many jurisdictions, like a couple of weeks ago, Austria said they were coming off of controls. And then Trump was wisely said that each state, it's up to each state to come off of controls. And some did not even go to controls. So that's going to ease. But underneath it, you have this underlying pattern of a great financial bubble, which completed in January. It had a horrendous whack, but the Dow Jones was down 37%, and often a serious liquidity problem can run for about 2 months. Mm-hmm. And then I compared it to 2008, where the equivalent decline, I think, was 40%. And then in 1929, the equivalent decline was 42%. So 37%, it's a bad hit, but there have been worse. And what I suggest is that if this market had peaked in, say, this coming September, and if then the virus had appeared, and you would then have had the liquidity crisis in the fall, when it would be a whole lot worse than otherwise. So this is what we're gearing now, Kerry, is that often in a year you can have favorable movements to about mid-year, like base metals can be favorable into mid-year. Crude oil can be favorable into mid-year. Lumber is another one that has a seasonal high in June. Mm-hmm. So we're in a period where when these more immediate liquidity problems get sorted out, where the last of the weak hands are forced out. So we've had this since, what did we do, March the 5th or something, when we published that it was time to look for some constructive action, which would be basing and testing the previous lows, and that this possible constructive action could carry through into, say, June or July. And then when we get there, then you start looking at industrial commodities again. And gosh, the chart on crude oil always shows a low in January or into February. Mm-hmm. Copper can often have a low in November, December, and also lumber. So after mid-year, Kerry, we would start worrying about the seasonal decline in industrial commodity prices. And then we'd also look and recall that throughout history, you can have important lows in the stock market in October. And then, of course, you got the old sell in May and go away. Well, the opposite occurs. So I think we'll keep on this path that the Wuhan flu can ease, but the underlying pattern is that a great financial bubble has completed, and probably the post-bubble contraction is underway. And we can, with having so much history, Kerry, I think we're in a good position to determine whether the post-bubble contraction is on or not. And at this moment, I think we're in the path leading to a contraction. And this gets us to gold and silver. And it was a long time ago that I sat down and figured out that in order to determine gold's behavior through all these financial crises and booms and busts, is I took a price of gold and deflated it by the consumer price index in the senior currency, which was sterling and since the 1920s, the U.S. dollar. And it provides a very clear pattern, is that the gold's real price goes down in a bubble. And then with that, gold stocks underperform the main action, which is in all kinds of other stocks, industrials, let's call them, or high-tech stocks. And so we had this one where gold's real price rose to 2011 with that speculative fever in the precious metals. And then it declined into 2017 and 2018, where it made a base. This is just straight gold divided by the consumer price index. And then it has turned up. So early last year, it broke the 10-year downtrend. And then the latest posting for March was a new high for the move. So gold's real price, adjusted for inflation, did what it should do in the final stages of a great financial bubble. It went down. And then it has been doing what it has done in previous bubble crashes, turns up. And this is very reliable. And the good part about the turning up, Kerry, is that let's just take a look here. You take a look at the chart of gold relative to crude oil, and it's been incredible. So then I checked with my friends who are mining engineers or geological engineers, and 30% of the cost of operating a mine is direct energy and related to petroleum prices. And then another 30% relates to blasting agents and stuff like that, and that also relates to petroleum prices. And then another 30% is wage costs. So here then, the other thing that we plot going into the end of a bubble is the base metal prices,
right,
and industrial commodities, and they go up in real terms in the financial mania, and then they turn down. So if you go back to 2011, when the excitement was in both base metals and in precious metals, and you had the problem that gold miners couldn't get tires for their big earth-moving machines. But now with the price of base metals so weak, there are mines shutting down, and you've got equipment available, and you've got miners available, and so I can just see it as working beautifully. So as the normal instruments of credit expand during a mania, and then they invent new kinds of instruments, then you go into a liquidity contraction. Liquidity just disappears. So on the other side of the equation, you got the real price, Mother Nature putting the real price of gold up, and miners producing more of it.
Right.
And that gold then goes into the global financial markets and starts to improve liquidity. So it doesn't matter what the price of gold is in U.S. dollars. What matters is the spread between what they're getting for bullion and how much it's costing them to operate their mine. And we have known now that the costs are quite depressed. Wages, energy costs, equipment availability, everything's there. So, but the problem is that the gold stocks are subject to what's going on in the big stock market. And
right.
While the liquidity crisis sets up the bull market for the gold sector, the stocks are still going to be whipsawed by what's going on in New York. But our view is into late in the year was that on the big stock market, people should be selling the rallies and not buying the dips. And then the advice on the gold sector, once it got hit, is to buy the dips, because eventually it may take a year or so to get sorted out. But then we go into the long bull market for the sector. And I'll give you an example. Like Homestake was the premier producer in the 1920s and 30s. And as far as I can tell, they didn't change their rate of mining. And in 1929, their earnings were down quite a bit because their costs were up and the price of gold was $20.67 an ounce. And Homestake crashed down to, I think, 8 1/8 in 1929. And then you could have bought it for $9, let's say, in 1930 and 31. And the real price started up, such that by the end of 1932, gold was still at $20.67 an ounce, but their earnings were up something like 130%, and so was the stock. And the reason why I did it to the end of 1932, because it was in the first quarter of 33 when Roosevelt started screwing around with the price of gold and then pushed it up anyways. And the real price of gold would have gone up anyway. So
right.
The $9 purchase of Homestake, the high, I think that it traded in 1935-36 at, say, $65 a share. And in those days, gold miners virtually paid out everything they earned through dividends. So the mid-30s, Homestake was paying $4.50 a share dividend on a 1931 purchase at $9. It shows how much money in a deflationary world the gold miners can make. Kerry, this is going to get very exciting.
Hey, and the Homestake of today is now Newmont, right?
Sure.
Homestake was acquired by Barrick, but hey, Barrick has had a nice improvement. But when you've got basically free energy, Bob, and now a lot of the mining activities way more energy intensive than they were back then, because you didn't really have like grinding machines like you have now to grind up the rock. And when you take all that into account, these companies are going into a new golden era, aren't they?
FSN Radio. It's all about what's next.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
The Financial Survival Network. It's all about what's next.
Oh, yeah, it is. And here's one I'm going to date myself with, but the story is funny. So in 1972, I was with a very good Canadian brokerage firm, did a lot of mining business from way back, and also was running the arbitrage between New York and London. So it was a very fine firm. And they had a great Canadian promoter into the office one afternoon. He had some hot story. His name was John Doyle. But as a warm-up guy, he had a much older man, very dapper dressed, double-breasted charcoal gray suit. So he was warming up, telling us how great this John Doyle promoter was. And I'm going to emphasize again that this was 1972, a long time ago. So after the pitch, I went to this older man and I said, "Were you in the financial markets in the 1930s? And he says, "Yeah." He says, "I was in Montreal with a mining brokerage firm." And I said, "Oh, great." Because I said, I knew that the senior gold stocks did very well in the 1930s deflation. I said, "Tell me what about the juniors?" And he said, "We were doing a lot of financings." And then he looks at me in the eye and he says, "Sonny," he said, "in 1933, one of my bigger accounts gave me a brand new Ford Roadster as a gratuity."
And that was a big
deal.
So
were they making money in juniors?
Heck yeah.
Of course they were. It was a fabulous market.
Yeah.
In the 1930s. So, and then you go back, Kerry, every every great financial bubble reaches a climax, crashes, and is followed by a lengthy contraction. And the one sector that you can analyze that will do well, now, there will be some new companies, there will be some new processes, high-tech stuff that'll come along, and you'll get a play out of it. But you can't predict that ahead of time. The only thing you can predict ahead of time is that the gold sector will do very well. And maybe one of our biggest customers will buy me a brand new Ferrari Roadster.
We can only hope. I could go for one of those too. It's a little impractical, but fun.
No, I wouldn't have one of those new hot Ferraris. I've had older Alfa Romeos as collector's items, and I've enjoyed those. But no, I wouldn't buy it. For me, a Ferrari, unless it's got a V12 and it's up front, it's not a Ferrari. Those are all go-karts and Lamborghinis and stuff like that. I wouldn't have anything to do with them. So, Kerry, we're looking for an absolutely fantastic bull market for the gold sector. Now, the other thing that you mentioned in your intro was silver. And for the last few years, silver has frustrated silver analysts, but then they have a problem because they look at supply and demand. And of course, silver is always suffers less supply than demand. But you can't go from in metals prices analyzing supply demand and then go to price. But again, history shows us what happens to silver is that in a boom, gold and silver can rally. And if you have a bull market for the precious metals, silver, of course, is going to outperform gold because it always does. So we'll go back to first part of 2011 when we were in that terrific mania.
Yeah,
and we had learned in the late 1990s that the key to the end of a gold bubble is what happens in silver. So we do the silver-gold ratio and use the weekly RSI, the momentum thing. And we found that if that weekly RSI gets above 80, the speculation is becoming dangerous. And in, I think it was April 2011, that RSI got up to 90. So we looked back, and the only other time it had been at 90 was in January of 1980 at the peak of that one. So we pointed out that speculation in gold and silver had become dangerous and that a bear market was likely. And this, of course, worked out. So you had the RSI up to 90 as the signal that was peaking in 2011. And then for the last few years, you figure, now, how the hell can we get some symmetry out of this and have a crash in gold and silver such that you had that weekly RSI opposite?
Yeah.
And I couldn't imagine it. And then you hit February, March with this disaster, and silver fell relative to gold, and that we did on that weekly RSI get the opposite, which was 11. So then where 90 was the sell in 2011, 11 in early March, I think it was the equivalent buy for the sector, with the understanding that the gold stocks will be whipsawed relative to what's going on in the big market. So, and also in December, I guess it was, I remember seeing a study that somebody said that at 87, the gold-silver ratio was way too rich for gold and that you had to buy silver. And we wrote that, hey, if we go into a crisis, the gold-silver ratio could go up.
It could go up.
And I just pulled a number out of the air, like 115.
Yeah.
And, it hit 130, which was pretty wild. But this has been the feature of every post-bubble contraction. The silver underperforms gold hugely, and we expect the same thing to happen. So this is where, if you're going to be in the precious metals, you want to be really weighted in the gold sector. Or if you're in, like if you've got a junior exploration company, you want to make sure you're in mainly emphasized in gold, because that's where the best action will be. And so far, so good. And I did a study last month and on this overall thing, Kerry, that if anybody wants, they can get in touch with us or with you, and we can send it out.
Yeah, sure.
But it concluded with a very old saying. I've been an exploration geologist since I graduated, and that was a long time ago. I worked in the field. I worked in underground and all that sort of stuff, and I really do like the exploration side, because when you come up with a winner, you really make money. And you have to focus on the best product, and that will be gold. Now, if you come across, say, a really good silver showing and you're getting good results, you got to go with it. But if you're deciding ahead of time whether to go for gold properties or silver properties, you go for them. But then, having been an old timer on the exploration side, there's a classic story that you're at the top of an exploration bubble is when some younger promoters get a hold of that property in New Mexico that's had so many holes drilled in it that when the wind blows in a certain direction, the property whistles.
Yeah. That's funny.
Kerry, we're not there yet.
Yeah.
As a matter of fact, that's not even on the horizon yet. But we will get there. And the exploration side can be just so dynamic and so profitable. And when you create wealth through drilling off a property, it's very exciting.
It really is. It's the most exciting business in the world 20% of the time, and the most frustrating, aggravating business 80% of the time. And
oh, don't I know it?
Yeah, right? Isn't it true? I mean, you got the government after you. You got Indians after you, trying to scalp you. You've got the environmentalists after you. You got labor issues. You got jurisdictional issues with countries. I mean, my hat's off to anybody who can navigate all these competing interests and actually bring a mine into production or discover a mine and sell it off for big money. It's really not for the faint of heart. And I really feel that now it's more complex than ever. And if you have the skill set that you can do this, then I'm amazed, It's
I've seen the business change, because living in Vancouver, I mean, I've been part of the play, but decades ago, you had the huge companies like Placer.
Right.
And they would do grassroots, and they came up with grassroots studies in Papua New Guinea and came up with a huge gold property. Or they were also pretty good at dealing with promoters, junior guys that come along with a deal. But then you've spent now, I guess, 25 years where competent geologists have realized that they get a better shake by not working for the major, but by learning business techniques, learning the financial markets, then going out and forming their own companies, raising the money and going out and doing the grasswork stuff. And it has been wonderful. There's been discoveries, and it will continue. And there's never been such competence on the junior side, because they've got the geologist, and you got a whole lot better understanding now on the geology of gold systems. You've got capital markets that in a good market where you can raise the money, and I have friends of mine have been working on a discovery in Mexico, just east of Mexico City, in the middle of nowhere. And the village was, when they came in, it was 10 years ago now since they made the discovery. But that village, there were people there that had not transacted in a currency or coin for years. It was barter system. There was no money.
Wow, that's amazing.
So anyways, these guys come in, and one of those lucky ones, the first drill hole was the discovery hole. So then they have taught the locals how to run a diamond drill. They've learned how to become drillers. Then they on rough terrain, you have to set up sets of timber sets where you set the drill on. So they brought some very experienced guys from southern British Columbia down there, and they showed the locals how to do timber sets for setting up a drill. So the village really likes this company, and but then you've got the NGOs coming in and trying to mess it up. But so far, the village knows where prosperity is going to come from. But as I say, I've seen this just with one junior company has taught locals how to diamond drill and taught them how to do timber sets and whatever else, sampling, the whole thing. And so where you went from a village that had no cash or very little cash or currency, you now have a little prosperous community with some industrial skill sets. So that's mining for you.
That's a great thing when it works. Love it when a plan comes together. Well, you've given us a lot to chew over here, Bob. We have to let that digest, and opportunities are there. I think the numbers and the history and the recent activity. One thing I just want to cover before we go, energy. So you saw that anomalous situation where sellers were paying buyers to take their oil off their hands. And that's something that's really...
There could be some... My colleague Ross Clark spent 20 plus years as a straight commodity broker. So, but there could be on an unusual settlement, like the front month in crude oil, nobody wanted it. And then also the big boys running the exchange, whatever the disaster is, they won't lose money on it. The loss will be foisted off onto the street, which is, and Ross is putting together a story on this, so we'll review it when it comes out. But it's extraordinary, but there was no place to deliver the product to, so you ended up with a minus. Now, our view in early January was that an old study we'd done in 2014 when crude was at 105, we had two possible lows, 37 and 27. So then as I said, in early January, said it reminded our long-term target of 37 or 27. And oh, by the way, that would be on annual averages. So the 27 and annual averages looks like it's going to work out. But again, at that point in January, early January, all we had was that you can get a seasonal low in January or February, and bang, in it came in. Again, made triply worse by this Wuhan flu. So the direction was right. The excess is a sign of the times. And now, so if we have a 27 average for this year, it's going to really sort out the men from the boys on the producer's side. But again, that would not be unusual, because those figures I came up with, 37 and 27, was based upon the 1930s on gold or crude oil relative to gold, and it fell to 1/3 or 1/4.
Mm-hmm.
So, and the 27 is the 1/4 thing, bullshitted around, changed for, from relative to gold to kind of a price. So,
sure.
The feature of both post-bubble contractions is weak industrial commodities, and that's what we're getting.
Interesting. All right, Bob. Well, hey, just tell us where's the best place to find you. We just do a Google search on you. Is that the deal?
Oh, sure. Yeah, just Bob Hoye, BOBHOYE, or bobhoye.com. And you can get into, we've got a couple of websites, and you can review our research and methods.
All right. Excellent. We always love having you on.
Look forward to talking to you next time.
Sure. Any questions, just send us an email, kl@kerrylutz.com, Twitter feeds @KerryLutz, Facebook page, Financial Survival Network, and of course our main website, financialsurvivalnetwork.com. Bob, always a pleasure, and we will talk to you again real soon.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.